All right, let's get right into it. Ever wonder how you can start investing in the stock market without, having to become a full-time expert overnight? Well, today we're going to break down one of the most popular ways to do just that: mutual funds. I mean, think about it. You see these huge companies on the news all the time: Reliance, TCS, Infosys, and you think, man, I'd love to get a piece of that action. But buying shares in all of them, or even just one, can seem totally out of reach, right? So how can you actually invest in India's biggest success stories, even if you're just starting out with a small amount? And the answer to that question is a mutual fund. So what is it, exactly? Well, at its heart, it's a really simple but powerful idea. Just picture a whole group of people all putting their money together into one big pot. Then that collected money is used to buy a whole bunch of different investments. Maybe it's stocks for growth, or bonds for stability, or a mix of both. It's basically teamwork for investing. And here's probably the best part. You're not the one who has to make all the tough decisions. The money in that big pot, it's managed by professionals at what are called asset management companies, or AMCs for short. These are the experts whose full-time job it is to research and manage all those investments. So you're not going it alone.
Okay, so that's the theory, but let's see how it works in the real world with a perfect example, the Nifty 50. Let's say you want to invest in the top 50 companies on India's national stock exchange. We're talking about the absolute titans of Indian industry here. Now, can you imagine trying to buy shares in all 50 of those companies one by one? Oh man, it would be a total logistical nightmare. It would be super complicated to manage and incredibly expensive.
But here's the thing, you don't have to do that. Instead, you can just invest in something called a Nifty 50 index fund. And this is where the magic of mutual funds really shines. With just one single investment, this fund automatically spreads your money across all 50 of those top companies for you. We're talking instant diversification with practically zero hassle. Pretty cool, right? So the whole process is actually pretty straightforward when you break it down. Step 1, your money gets pooled together with a bunch of other investors in a specific fund, which is sometimes called a scheme. Step 2, you're given units in that fund. You can think of these units as your personal shares of that big investment pot. And step 3, you earn returns as the fund's investments hopefully do well over time. So you're probably asking, okay, how exactly do I earn those returns? Well, there are two main ways this happens. First, through what's called regular income. If the stocks in the fund pay out dividends or if the bonds pay interest, that income can get passed along to you. The second way is through capital gains. This is when the overall value of the fund's investments goes up. When you decide to sell your units for a higher price than you bought them for, that profit, well, that's your capital gain.
Now, I mentioned a key term just a second ago, NAV. If there's one piece of jargon you need to know in the mutual fund world, this is it. So let's take a minute and break down what net asset value really means.
The net asset value, or NAV, is simply the price of one single unit of a mutual fund. It's calculated once a day, right at the end of the trading day. You can just think of it as the official price tag for your slice of the fund's pie. It represents the true market value of what you own.
And here's the bottom line for you as an investor. The relationship is super simple. If the NAV of your fund goes up, hey, the value of your investment increases. If the NAV goes down, your investment value decreases. It's that direct. Simple as that.
So how is this all-important number even calculated? It's not magic, it's actually just some pretty simple math. You take the total value of everything the fund owns, all its stocks, bonds, cash, you name it. Those are the assets. Then you subtract everything the fund owes, like fees or expenses. Those are the liabilities. And finally, you divide that final number by the total number of units that all the investors hold.
Let's look at a quick example to make it real. Let's say a fund has total assets worth 63 crore rupees. It has liabilities or costs of 3 crore. So its net assets are 60 crore. Easy enough. Now, if there are 6 crore units spread out across all its investors, you just divide 60 crore by 6 crore. And there you have it. The NAV for one unit is 10 rupees.
So after going through all of that, from pooling money to calculating NAV, what's the big picture here? What's the main takeaway for you, the investor?
In a nutshell, mutual funds just make investing so much more accessible. They make it simple, like with our Nifty 50 example, where one investment gets you a piece of 50 companies. They make it diversified, so you're not putting all your eggs in one basket. And they're professionally managed, so you have experts looking after your money.
So, there you have it. We've covered the what and the why. You now have a really solid foundation for understanding what a mutual fund is and the powerful advantages it offers. The only real question left is, are you ready to start exploring the how? Because trust me, understanding this is the first big step on what can be a really powerful investment journey.